Well, it's time for the markets with Leighton Spann, but since Leighton is not here this week, you have to put up with me. The Planting Intentions Report will be released on Tuesday. A survey by Farm Futures magazine says a record number of beans will be planted in 2015. We'll see the government number on the 31st. As far as the markets this week, low oil prices could hurt cotton sales at retail. The issue of antibiotics in chicken pressures fast food companies, while farm gate milk prices may nudge lower. Well, now cotton is being described by some analysts as a limited market here at the end of March. Traders say that despite expected lower planted acreage, competition from cheap synthetic fabrics could keep a lid on cotton prices. Synthetics are cheaper now because of the drop in oil prices. Market watcher Sue Martin says that the strength of the dollar in recent weeks is not helping the cotton trade either.
Cotton had a nice little holding pattern and then kind of just all of a sudden started to cave over. You know, the dollar I think might be affecting that too. But being an oil seed, Malaysian palm oil has given up and fallen on concern that it's starting to lose favor. Slowing economy in China means maybe they don't buy as much cotton. And of course they had built up huge reserves and sold a bunch of it out last year.
Well, analysts call the adjustment made by the USDA to the corn ending stocks this month as, quote, minor. Well, however, the market reacted just like it reacted when the same report didn't change soybean ending stocks at all. Extension economist John Michael Riley explained it to Leighton.
Well, John Michael, I understand USDA tightened corn ending stocks. What changed to bring that about?
Well, we saw smaller use at the ethanol level and smaller exports. That was somewhat offset by increased feed use. But at the end of the day, 50 million fewer bushels of corn in the ending stock number. The market was looking for roughly no change, and so that definitely, had a minor impact. Again, 50 million bushels is a drop in the bucket in the big scheme of things when you're talking about a 14 billion bushel crop, a record crop still expected. So overall, I think it was minor changes. Market reacted because markets react to things like that, but for the most part, it was some minor changes. We're seeing fewer miles driven today. We've seen a huge increase in the the value of the U.S. dollar relative to other currencies, and that's really put some pressure on exports. Both of those were reflected in the report, and also we're seeing cattle being fed a little longer because of the market, and so we're seeing more corn put into feedlots.
And although we talk about, a change there, still U.S. ending stocks still way above what they were a year ago, right?
Oh, yes.
We're not running out of corn by any means.
Right, we're right there, just under the 2 billion bushel mark with our corn ending stocks, which is much a relief in the marketplace. Of course, I guess it depends on what side of the market you're on. As a corn producer, would like to see it maybe a little tighter, but overall, we have a lot more cushion in the market compared to where we have been in recent years.
Now, soybean ending stocks were left unchanged, and that kind of caught the market off guard, right?
That's right. Market participants were looking for a 10 million bushel decrease in ending stock, still sitting there at 385 million bushels soybean ending stock. So again, minor change in the big scheme of things, but overall, this time of year, those minor changes are expected because we know a lot more about what the crop is last year's crop looks like. So these minor changes, but they still have an impact on the market.
All right, we're coming up on that all-important planting intentions report at the end of March. What do you expect the market for beans and corn to do between now and then?
Well, USDA had their Outlook conference at the end of February, and they're calling for smaller soybeans and smaller corn, which I think the soybean number kind of took market participants a little bit out of off guard. Sorry, yeah. Yes. But overall, I think that should be expected. We're looking at a corn to soybean ratio right now of about 2.3. That's probably average. So we really shouldn't see there's not really one leader here in terms of prices dictating acres, but it does look like that right now we're relatively smaller on both fronts as a result of lower prices.
Well, the increase in the value of the dollar that John Michael just mentioned also hurts the wheat market as well. Traders say that the overall fundamentals remain bearish. Analyst Darren Newsom says European wheat will sell first given the situation.
The dollar still too strong, euro still too weak. You just mentioned how it continues to come down. So right now we're going to be moving. We're going to see more European wheat move. It still seems that the argument is that we're going to see some U.S. wheat move. I mean, we've got an inverse in the Chicago market in the March to May, something we just normally don't see. So at some point it seems like we're going to see our exports pick up, but it's just not there yet.
The livestock sector furnishes a topic for our trivia question this week, and here it is. How much of the pork produced in the United States is exported? Is the answer 10%, 14.8%, 26.5%, or 37.3%? You'll find out in a few minutes. Well, Reuters reports that the pressure is on in the fast food industry. Pressure to phase out the use of chicken raised with antibiotics that are important to human health. McDonald's raised the stakes recently when it announced that it will have all antibiotic-free chicken within 2 years. KFC, meanwhile, is really on the hot seat since it has no publicly stated policy on antibiotic use in the chicken it buys. And Chick-fil-A says about 20% of the chicken it serves nationwide is raised without antibiotics as of now. Its entire supply chain will be antibiotic-free by 2019. Well, moving to the dairy sector, the United States is described as being full of milk right now. Analyst Naomi Bloom says until the market moves through the current glut, farm gate milk prices will likely be stable to sideways, right at the cost of production.
What we had happen was, that big rally we had last year, and then as we had said all along, it's just a demand thing right now. And so once the demand stopped, everything fell apart. But then just a few weeks ago, then the Frontiera global export market, they said that they thought New Zealand production was going to be down 3.3%, and anything over 1% in the milk world is a big deal. So that's what got that market to turn around back higher. But here's the thing, we still have all of this supply.
Back to the trivia quiz to wrap things up on Farm Week this week. And C is the right answer. Over 26% of the pork produced in the United States is exported to another country.